Liquidity trap. A liquidity trap refers to a situation in which an economy experiences stagnation despite very low interest rates. In this condition, expansionary monetary policy becomes ineffective because individuals and businesses prefer holding onto cash rather than spending or investing. This phenomenon typically occurs during recessions, where economic confidence is low and consumers are reluctant to engage in economic activity, regardless of favorable interest rates. Although central banks inject liquidity into the system through rate cuts or asset purchases, the demand for money becomes unresponsive to further interest rate changes. This inelastic demand curve flattens, indicating that people expect rates to rise in the future and fear losses from investing in low-yield bonds. In a liquidity trap, economic activity slows, inflation drops, and investment levels fall. If this continues, it can lead to deflation, further weakening demand and worsening economic contraction.
Right now, Calcine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
As interest rates rise from deflationary pressure, loan repayments become more difficult, potentially increasing default rates and the burden of non-performing assets on banks. This can deepen the economic downturn and make recovery more challenging. To address a liquidity trap, several solutions have been proposed. Increasing interest rates may seem counterintuitive but can incentivize lending and long-term investments. More commonly, expansionary fiscal policy, such as government spending and tax cuts, is recommended, as suggested by Keynes. Unlike monetary policy, fiscal interventions can directly stimulate demand and restore confidence. Another approach is price reduction, particularly in asset markets, to attract investors. Additionally, global cooperation may help balance the impact if only one country faces the trap. Despite its benefits, fiscal stimulus faces criticism for potentially crowding out private investment by shifting funds from the private to the public sector. However, Keynes argued that in a liquidity trap, such borrowing replaces idle savings rather than crowding out investment. Still, for fiscal policy to be effective, consumers must expect moderate inflation. Real-world instances include Japan's prolonged economic stagnation with near-zero interest rates, the Eurozone struggles post-Great Depression, and the 2008 financial crisis, all of which illustrate the persistence and complexity of liquidity traps in modern economies. For more related videos, please subscribe to the channel and click the bell icon to get notifications.